We started the morning brief here this morning, and Myles, in the brief you wrote about tech stocks, which has been a big focus recently for us, for the market, a focus because of its absence, I guess, or a focus because of its lack of performance and the rotation away from it, although it's been bouncing a little bit in the past couple of days. But even despite that bounce, some of the research you were looking into kind of indicates that, maybe it's choppiness, I guess to use the best case scenario, is not over.
Yeah, and I think something that Lori Calvasina said to us yesterday, and she's the equity strategist over at RBC, is that the funding for a lot of this cyclical trade that we have seen, be so popular in the last 6 months, that money has come out of tech stocks. So there was a great chart that I saw over the weekend from the team over at Deutsche Bank showing flows into, and so this chart comes from RBC. This is how flows have flattened off for technology over the last year or so. So this is a cumulative number. So when that number is flat, that is showing that there's no additional money coming into tech, and that money is flowing into what we see here. TIPS, which are Treasury inflation protected securities. So you just strip the coupon, you don't worry about the price of the bond. And then materials, energy, financials, three key sectors within the rotation, let's call it the pro-cyclical rotation that we've seen within the market. Growth as a style within the stock market in general means you are buying companies that can grow their revenue and by extension can grow their profits, even if the overall economic cycle is not growing. Cyclical names, however, are going to see their business's success more levered to the success of the overall economic cycle. Over the last decade, certainly a 2% growth environment does not bode well for materials where you have a lot of investment, a lot of CapEx, a lot of heavy industry concentrated. It doesn't bode well for energy. It's a big part of the commodity cycle. Commodities are going to be higher in price, in higher demand when the economy is growing faster. And of course, financials, they benefit from a higher rate environment, but really, I think this is Dick Beauvais, who I heard this from, and maybe it's apocryphal or not, but financials are a levered bet on the strength of the overall economy. So the economy is growing 2%, maybe then the financial sector grows something more like 4 or 6%, and so we go on from there. And those have really been the most popular styles for investors. That's the macro backdrop, as Calvasina told us, against which tech remains challenged. Now, it doesn't mean that tech just doesn't work here. And you can look at the NASDAQ right now. It's just barely off of its record high. So, what's the big deal? What are we all worried about? Well, that's got the largest concentration within the S&P. It's been the most popular place for most investors, especially, hedge fund type investors over the last decade. And for the NASDAQ to be basically going sideways while you have the S&P and the Dow, hanging in there okay, and certainly some sectors within there working quite a bit better than okay. It's just a frustrating, choppy period. And I think that, Zazi, it just sets up for such a different environment. And anytime the environment within the market changes or remains changed, that's when people get uncomfortable and you see strange things happen. You see big underperformance, or you can see these kind of big, quick washout type moments. Think about 2018 as an example, a couple different times in that year. And so I think that's really what we're highlighting here. Maybe everyone thinks I'm an idiot because the headline says tech stocks are going to be challenged and the NASDAQ is higher today, and that's fine. But the backdrop against which tech stocks worked so well in the last decade is just not the state of play today.
So Myles, my takeaway here is that these tech stocks, big cap tech, they stay in the penalty box until inflation, until these numbers we get on headline inflation, they start to cool down.
I think that's a part of it, and I think the numbers on headline inflation, we might disagree on this, but if I am interpreting inflation as transitory, as most Federal Reserve officials are, I think higher inflation data now are essentially just telling you how quickly the economy is growing, how fast the economy is rebounding out of the pandemic-induced recession. And so you can call it faster growth, you can call it faster inflation, but that backdrop, yes, is going to be less positive on balance for big cap tech stocks than it's going to be for some of these cyclical plays. And, this also, guys, comes to another theme that we've discussed as well, which is just that like there's been a lot of pain underneath the surface. You look at some of the growthier, sassier type names, Julie, they're off 50, 60, 70%. Maybe Amazon, Apple, and Facebook can work in this kind of environment. But, your 20 times sales name that is growing revenue at 80%, but really only has top line of about $700 million, that name probably doesn't work as well when you can buy something like a Caterpillar and actually get growth from Cat because the economy is growing at 5%.
Yeah, although I would come back again to what Lori told us yesterday, which is that she is still positive on a fundamental basis. She's still positive on tech, right? And she didn't differentiate between the sort of different kinds of tech you're talking about, between the largest of the large and the growthier plays. But as always, when you're looking at these things, it depends on your time horizon. I mean, if you're buying these to retire 10 years from now, are tech stocks going to come back before then? Probably, right? At some point, at least. So if you're looking to buy them before the end of the year, well, then that's quite a different question. So, but I think it is interesting that she made that distinction, that she, on a longer term fundamental basis, that they are still constructive on tech.
Yeah, I mean, when Facebook and Google alone control the online ad market, lot to like. Generate a lot of cash. They only trade it 23 times or whatever it is. So again, as always, many shades of gray within the broader conversation.